Hello everyone, I'll just get myself sorted. Now, first and foremost, an apology for the last video. I saw some abhorrent changes, or should I say mistakes, that I'm going to need to change in that one, and I'll change that before we get to that topic again. Now, what we're going to look at today is taxation, and basically going to look at pay-as-you-go tax and also tax returns and that whole idea. But this topic is, even though I suppose every person pays tax, and it is confusing. You know, there are tax accountants, there are people who specialise exclusively and only in this, because it is quite confusing. So I'm going to try to break that down and look at kind of how it all works. Up until now, we've looked at this idea of gross pay. And with gross pay, if you take away all the things that you pay for in work, things that we call deductions, this makes what we call our taxable income. So what we get paid minus all the things that we take out becomes our taxable income. Now, from our taxable income, we take away our income tax, in other words, just what some people just call tax, and also our Medicare levy. And what's left is what we take home, which is called our net pay. So everything after tax, everything taken out, what we end up with in our pocket that we can spend is our net pay. Now, these numbers aren't necessarily accurate, but I'm using these to explain the idea that if you end up with a gross pay minus deductions of, just say, $100,000, right? And at the end of the tax year, or the financial year, which is at the end of June, you end up with having to owe $25,000 tax. You might come across a bit of a problem, because if you've spent every cent of your $100,000 that you've earned, and then all of a sudden at the end of the year someone says, hang on, you owe us $25,000, or the government says you owe us $25,000, most people wouldn't have that handy. Okay, it's not an easy thing just to pull out $25,000 because you owe it to the government. And so what the government does, or what initiative we have, is this idea of pay as you go tax. In other words, PAYG. Anybody who has earned over probably about $200 a week will have looked at their payslip, and some of you might have seen that PAYG tax subtracted from their income. And what that is rather than hitting people with a lump sum bill at the end of the financial year, you can every week you take out a little bit of money, $200, just say $200 a week for the whole year, and hopefully it will add up to that. Now, as we see, $200 times by 52 will not add up to $25,000. And so what we have to do at the end of each financial year is lodge what we call a tax return. And a tax return is when we declare how much we earned, and compare it to how much we were taxed, and any difference we have to pay. Any difference is paid or paid back. Now let's use the example I gave you just before to kind of explain the situation. If we have a taxable income of $100,000 and we work out, or the ATO says that we have to pay $25,000 tax. Now this is just numbers I've pulled out of my head. Luckily, we've paid PAYG tax of $200 per week. Luckily, that's what we've paid. So, how much tax then have we paid over the course of the year? If we've paid $200 a week already as down payments of tax throughout the year, then we've already paid, just in weekly deductions, $200 times by 52 weeks a year. So we've already paid $10,400 tax already. There's a problem though, because if we've paid this much tax already, and this is how much tax we owe, then there's a difference there. Okay? There's a difference of $14,600 that we still owe to the Australian Tax Office. And so after you lodge your tax return at the end of the year and you declare how much you've paid in tax, they say, oh, well, you owe this much tax, and then they compare it to how much tax you've already paid in PAYG tax. The difference, or how much you still owe, you're going to have to pay to the tax department. Alternatively, if you pay too much tax, let's say rather than paying $200 a week, you pay $500 a week, then would have paid more tax than what you owe, and so in that case, the tax office gives you money back. Okay, and so that's when you get a tax return. So let's say, hypothetically, rather than $200 a week, let's say we paid $500 a week. Now, 500 times by 52, we end up paying $26,000 in tax. That means that we've already paid $26,000 tax, and we owe only $25,000 tax. That means we've paid $1,000 too much. And therefore, the ATO owes us $1,000. And that's what we call a tax return. Most people at the end of their tax year, when they lodge their tax return, hope that they've paid a little bit too much tax so they'll get a little bit back. Sometimes that's not the case.